And that wraps up today's trading action here. Taking a look at all three of the major averages ending to the downside. The Nasdaq off at just over 1%. S&P off 0.7%. Dow off 93 points. In terms of the sector action that Jared was just walking us through, energy by far the worst performer in today's trading, off just around 2%. We're also looking at losses from technology, real estate, and consumer discretionary. All right, let's talk about the recent market action and what we could expect going forward. For that, we want to bring in Deborah Cunningham, Federated Hermes Chief Investment Officer of Global Liquidity Markets, and Andrew Slimmon, a Morgan Stanley Investment Management Senior Portfolio Manager. Andrew, let me start with you just in terms of the downside, risk playing out in the market today. Once again, we are looking at losses. We saw a bit of optimism going back to a week ago today and what we saw in trading action last Tuesday. How do you think things shake out from here between now and the end of the year?
Well, I think near term, you have a very tough competitive situation for equities, which is there's uncertainty about inflation, there's uncertainty about the Fed, and there's uncertainty about earnings. And on the meantime, you can go out and buy a 2-year treasury at 4.3%. So it's tough for stocks to really do well when assuredness of short-term yield curve looks pretty good. Later this year, if we get better inflation prints, I think it's a better situation for equities. But I think it's tough near term. That continues to weigh on the market.
And Deborah, as we mentioned some of that Fed uncertainty, to what degree has the Fed contributed to a lot of the uncertainty about really the path ahead that investors are now concerned about?
Well, certainly I agree that inflation is ruling the roost from a standpoint of what the Fed's actions are. I think to some degree, they were very late in the game in the context of, sticking with, their thought that this was transitory, until really just a year ago, the fourth quarter of 2021. So what you now have is a Fed, I think, that's continuing to play catch up. And people look at mortgage rates and they say, oh, my goodness, they've doubled. And, what is this going to do to the housing market? Or they look at short-term interest rates and say, just what we just heard, 4.3% for, a very short-term government risk. Yet when you look at something other than the last 10 to 12 years since the financial crisis, that was sort of the norm from an interest rate perspective, with inflation much less than it is today. So we got used to something with a low inflationary rate and, to some degree, a zero premium over that low inflation rate. That just is not continuing now, and we don't really see an end to it in the near term. So, I think the Fed is in unison, whether it's, Chair Powell, whether it's the governors, whether it's the other voting members of the FOMC, they're in unison saying this is our chief concern, and we are going to continue to battle this by increasing rates and, releasing bonds off the balance sheet, both ways, trying to quantitatively tighten, as well as, with monetary policy tighten from an interest rate standpoint. Don't really see an end to that at this red hot moment.
They're hoping for a good CPI print on Thursday. Andrew, Hurricane Jamie Dimon out with his latest that in 6 to 9 months, the Fed will tip us into recession, that Europe's already there, but that the markets have another 20% to fall. Your thoughts?
Well, this has been the story all year, as the economy has proven to be stronger than what people expected. But in the future, it's going to weaken. You could have played that 6 months ago, with all due respect. So I think the real question is, will it come to fruition? If it does not, stocks will recover. I can't imagine that the tightening that the Fed's done will continue will not affect the stock market at some point. But the key point, and maybe this is where stock picking active management can add a lot of alpha, is there's so many stocks down 40, 50, 60% that they're already reflecting a recession. I understand the S&P isn't at the cap weighted index, and that's because there's a few big stocks that are only down 20% or less. But there are a lot of stocks that already reflect a recession. So I don't see that as tremendous downside for most stocks. Could be for the S&P cap weighted.
Deborah, what do you think? I guess, how do you think this sets us up heading into earnings season? We're going to start hearing from the big banks later this week. And then, of course, we'll get a lot of those larger tech names over the next couple of weeks. When it comes to the surging dollar, the uncertainty when it comes to the Fed, I guess, how do you see that impacting this round of earnings?
You know, we've been surprised quarter after quarter with earnings that we thought were going to soften, we thought were going to turn down. And in fact, they have held out very nicely. So I think that goes to, from a banking perspective, when you're talking about JP Morgan, Citibank, that, they're large global entities with lots of diversification that is working in their favor during this, challenging time from an economic perspective. But that can only, hold out for so long. So our expectations continues to be heading into the fourth quarter that we're going to see impact on earnings, which ultimately then, has, a broader effect in the context of the finances of the issuers themselves.
And Andrew, in this environment, you say we buy fear and sell greed. What does that mean in terms of the investment strategy right now?
Well, I mean, the only consistency to my business, right, is the emotional element that's brought to equity prices. Things swing to extreme. And I think about really the last, since COVID, there's been a few extreme opportunities. One was buying the travel and leisure stocks right into the midst of the pandemic when they priced as if no one was ever going to leave their house. And then energy futures went negative. And boy, oh boy, now everyone loves energy. And then fast forward today, I think the fear is, consumer sentiment is at an all-time low. And those create buying opportunities to buy quality companies in those sectors that have been unduly hit. But I don't think it's going to be tomorrow that consumer sentiment is going to improve. But as I said before, a lot of consumer discretionary stocks already priced in a recession. So if, in fact, we do see some improvement, those stocks could have a lot of upside. I think greed, the flip side is, look, energy went from negative, no one liked it. Now it's owned close to $90 a barrel, and it seems to be the number one area. I don't say this is the top. I just think that there's more upside in other areas as that area has garnered and attracted a lot of money. So buying fear is all provides upside with the right time frame more than trying to get involved with a group that's very crowded.